For years, the trade-offs of easy money seemed distant until the math started to change. After an aggressive policy tightening cycle and growing bond market strain, the system faces a refinancing reality that gets harder to ignore. The soft landing narrative may hold the headlines, but deeper imbalances have accumulated over time. When confidence shifts, it often shifts fast, and that repricing is the moment that matters. One scenario is that this pressure leads investors toward hard assets. But how does that connect the bond market to a metal like silver? For generations, government bonds served as the financial system's bedrock, stable, dependable, and universally trusted by institutions. They were the ultimate safe haven, a foundation upon which entire portfolios were built. But when that bedrock begins to show cracks, smart capital starts asking difficult questions about what safety truly means in a new era. This isn't a forecast of doom. It's an educational framework for understanding how structural stress can reshape financial incentives on a global scale. We are witnessing a system grappling with unprecedented levels of debt, where the old rules of stability are being tested. In such an environment, a potential reallocation could occur, a quiet but powerful shift away from paper claims and towards scarce, tangible assets. This is not just a normal market cycle. It represents a potential structural change in how wealth is preserved. One analyst, Michael Oliver, has outlined a conditional scenario where this dynamic could lead to a significant repricing. He suggests that if institutional trust in sovereign debt erodes, assets with tangible value could experience a dramatic revaluation. This is presented not as a certainty, but as a high upside possibility worth examining through a disciplined lens. The core of this investigation is about pricing dynamics, the hidden vulnerabilities within the bond market, and the changing demand patterns that signal a deeper shift is underway. Silver sits at the fascinating intersection of this debate, a nexus of monetary history and critical modern industry. Its dual nature makes it a compelling subject for anyone trying to understand the crosscurrents of this new economic landscape. To truly grasp its potential role, we must first understand the epicenter of the financial world, the U.S. Treasury market. In the next section, we will explore the mechanics of bonds, yields, and why the slightest tremors in this market can send shockwaves across the globe. To understand the bond market's current stress, you have to start with the system's foundation, U.S. Treasury bonds. These instruments are treated as the benchmark for collateral across the global financial system. They are the assets that banks, corporations, and central banks hold as a store of value and a source of stability, often described as the world's risk-free asset. This deep assumption of safety allows the entire structure of modern finance to function, providing a baseline against which all other risks are measured. However, confidence in this risk-free status can be tested, especially during tight financial conditions. When economic variables shift, the perception of risk can also change, even for assets considered fundamentally safe. The mechanics are straightforward, but have far-reaching consequences. It all starts with the relationship between bond yields and bond prices. The key dynamic to remember is this: when yields rise, existing bond prices fall. Imagine a bond issued a year ago with a 2% interest rate, or yield. If new bonds are now being issued with a 4% yield because of changing market conditions, that older 2% bond becomes less attractive. To sell it on the open market, its price must be lowered until its effective return matches the new 4% rate for a potential buyer. This price drop creates an unrealized loss for the holder of the old bond, a loss that exists on paper but can become very real if the bond needs to be sold. This matters for the large institutions that hold trillions of dollars in these securities. Central banks, commercial banks, pension funds, and insurance companies all maintain vast portfolios of government bonds. As yields have moved higher, the market value of their existing bond holdings has declined, creating significant unrealized losses across their balance sheets. While these are just paper losses for now, They reduce the capital cushions of these institutions and can constrain their ability to operate, lend, or respond to unexpected shocks. In a stressed scenario, if an institution is forced to sell these bonds to raise cash, those unrealized losses would crystallize into actual, tangible losses. Adding to this pressure are the significant financing needs of governments. The U.S. government, like many others, funds its operations by issuing new debt. It must also constantly refinance old debt as it matures. Estimates suggest that trillions of dollars in existing U.S. debt will need to be refinanced over the next few years, alongside the issuance of new debt to cover ongoing budget deficits. This large and growing supply of bonds requires a consistent and deep pool of buyers. When the supply of bonds increases substantially, it can strain demand. If there are not enough buyers at current prices, sellers must offer higher yields to attract the necessary capital. This creates a challenging dynamic where the very act of funding the government can push yields higher, which in turn lowers the price of all existing bonds. In a market with delicate supply and demand balances, even small shifts in buying appetite can lead to outsized movements in yields. The system is sensitive, and large-scale issuance can test its limits. This situation is also unfolding within a broader global context of reserve diversification. For decades, central banks around the world have held U.S. Treasuries as their primary reserve asset. However, there is an ongoing, gradual shift in this landscape. Some countries are looking to diversify their holdings into other assets, including gold or the currencies of other nations. Discussions among groups like the BRICS nations often include the goal of reducing reliance on a single currency and asset for international trade and reserves. This is not a sudden abandonment, but a slow-moving structural change in the composition of global reserves, which could gradually alter the long-term demand base for U.S. debt. These factors can combine to create a potential feedback loop. It begins with rising bond yields. Higher yields mean the government must pay more interest on its debt. These higher interest costs increase the budget deficit, which then requires the government to issue even more debt to cover the shortfall. This increased supply of debt puts further upward pressure on yields, and the cycle can begin again. Each turn of this loop reinforces the last. Higher yields lead to higher interest costs, which lead to more borrowing, which can lead back to even higher yields. This self-reinforcing cycle puts the entire system under closer scrutiny. The stability of the bond market is not just an abstract financial concern. It is the bedrock upon which much of the global economy is built. The price of risk-free assets influences every other financial decision, from mortgage rates for homeowners to the cost of capital for businesses. Therefore, sustained pressure in this core market has the potential to ripple outward, affecting all corners of the economy. The interconnectedness means that what starts as a technical adjustment in bond yields can evolve into a significant challenge for financial stability. The focus then shifts from the cause of the problem to the potential solutions and responses. The tools available to policymakers and the overall liquidity conditions in the market become paramount. How central banks and governments navigate this environment will determine whether the feedback loop is contained or continues to accelerate. Every action, from monetary policy adjustments to debt management strategies, will be watched closely for its impact on this delicate balance. The system's resilience is being tested. If bond stress grows, policy tools and liquidity conditions become the next focus. Silver's price discovery is heavily influenced by futures and derivatives activity. Short-run moves can often be driven by positioning and liquidity dynamics. While physical supply and demand set the long-term foundation, the day-to-day price you see on your screen is largely determined in the paper markets. This is where contracts representing claims on silver are traded in volumes that vastly exceed the amount of metal being physically produced or consumed. Understanding this market structure is crucial because it reveals how leverage and financial incentives can create significant disconnects between the price of paper claims and the value of the underlying physical asset. One of the primary venues for this process is the COMEX Futures Exchange. It's a highly liquid, centralized marketplace where producers, consumers, and financial participants trade standardized contracts for future delivery of silver. This mechanism serves a vital economic function. For instance, a mining company can use futures to lock in a selling price for its future production, reducing its exposure to price volatility. Similarly, an industrial user like an electronics manufacturer can lock in a purchase price, ensuring a predictable cost for its raw materials. Financial participants, in turn, provide the necessary liquidity that makes this hedging possible, all while speculating on future price movements. The sheer scale of this activity means that COMEX pricing effectively becomes the global benchmark for silver. However, the nature of this price discovery mechanism is the subject of ongoing debate. Some market observers argue that the massive volume of paper trading is simply a natural feature of a mature, liquid market that facilitates efficient hedging and risk transfer. From this perspective, large financial players are essential liquidity providers, and their speculative positions are what enable the market to function smoothly for commercial participants. Others, however, point to the concentrated nature of short positions held by a small number of large financial institutions. They argue that this concentration can create a powerful gravitational pull on the price, especially when combined with leverage. In this view, the incentives are not always aligned with reflecting physical fundamentals. Instead, they may be geared toward managing and profiting from large, leveraged derivatives positions, potentially leading to price movements that diverge from real-world supply and demand signals. A key vulnerability in this entire structure is the implicit assumption that the vast majority of contract holders will never demand physical delivery of the metal. The paper market functions on a fractional reserve basis, where the amount of silver registered and eligible for delivery in exchange vaults is only a small fraction of the total open interest, or the number of outstanding contracts. For the system to remain stable, most participants must be content to settle their positions in cash or roll them over into a future month. This works perfectly well under normal conditions, as most traders are speculators with no intention of taking or making delivery. The system is designed for financial settlement, not physical fulfillment on a mass scale. It is this reliance on cash settlement that allows the paper market to maintain a scale and influence that can, for extended periods, overshadow the physical market it is meant to represent. This balance, however, can be disrupted when a significant strain emerges in the physical world. Rising industrial demand is a primary catalyst for such a shift. Silver is an indispensable component in high-growth sectors, including solar panel production, electric vehicles, and advanced electronics. Its unique conductive and reflective properties make it difficult to substitute. As these industries expand, their demand for physical silver becomes less elastic and more insistent. If this growing industrial consumption coincides with constraints on the supply side, such as declining mine output, geopolitical disruptions, or logistical bottlenecks, the available pool of physical metal begins to shrink. This tightening is not immediately visible in the paper markets, but it slowly erodes the foundation upon which the derivatives pricing is built. When physical tightness becomes severe enough, the structure of a market participant's exposure becomes critically important. Holding a futures contract or shares in an ETF that relies on intermediaries and sub-custodians is fundamentally different from having direct ownership of physical bullion. Products that offer exposure through a chain of financial claims are embedded within the paper pricing system and its rules. Their value is derived from the derivatives market and is subject to its dynamics, including the risk of counterparty failure or changes in exchange rules during a crisis. In contrast, direct ownership of physical metal places you outside that system. The value of your asset is no longer defined solely by a futures price, but by what another party in the physical world is willing to pay for it. The difference is not one of right or wrong, but a structural distinction between a claim on an asset and the asset itself. As physical availability dwindles, the premium for immediate possession can rise dramatically, creating a bifurcation between the paper price and the physical price. This dynamic creates what can be described as a coiled spring effect. When the paper price of silver is held down for a prolonged period, whether due to concentrated short positioning, broad risk-off sentiment, or other financial pressures, it compresses the market. Energy builds within the system as the price increasingly disconnects from tightening physical fundamentals. This period of compression cannot last indefinitely. If a catalyst emerges, such as a surge in industrial offtake, a supply shock, or a loss of confidence in the paper settlement system, the spring can uncoil with remarkable force. The repricing can be sharp and rapid, as the market is forced to reconcile the price of paper claims with the scarcity of the real metal. The transition from a liquidity-driven market to a physically driven one can be abrupt, catching those positioned for a continuation of the old regime off guard. But if the mechanism is so well understood, why does it persist? The answer lies in the broader economic context, particularly the policy constraints and liquidity conditions that govern all financial markets. The structure of the silver market does not exist in a vacuum. It is deeply intertwined with central bank policies, interest rate cycles, and the global demand for financial leverage. The very conditions that enable this dynamic in precious metals are often the same ones propping up asset prices across the board. In the next section, we will explore how this system is ultimately backstopped by policy and what happens when that official support begins to waver. The interaction between market structure and policy decisions is where the true fragility of the current system is revealed, setting the stage for the next major shift in the financial landscape. When the system is under stress, policy choices often feel less like preferences and more like trade-offs. The architecture of the market itself, its plumbing, can begin to constrain the choices available to policymakers. The way Treasury auctions function, the behavior of primary dealers, the demand from foreign buyers, and the overall level of market liquidity can create feedback loops that central banks may feel compelled to address. A market that cannot efficiently absorb new debt issuance or clear existing securities isn't to just a technical problem. It can become a systemic one. When the machinery of funding markets begins to grind, the pressure to intervene can build, irrespective of other policy goals. The system doesn't always break in a single clean moment. It often bends slowly, straining against its structural limits until something has to give. In this environment, the term pivot can become oversimplified. A change in policy direction is not a single lever, but a dashboard of potential tools, each with its own consequences. It can mean a reduction in the policy rate, which directly impacts the cost of short-term borrowing. It can mean an adjustment to the pace of balance sheet reduction or quantitative tightening, which influences longer-term rates and the supply of reserves in the banking system. It can also mean the deployment of more targeted liquidity facilities, like standing repo facilities or other emergency lending programs, designed to alleviate specific points of stress without altering the broader policy stance. Each of these options represents a different path, a scenario with its own distinct set of risks and rewards. The choice between them is not always clear, and the decision often depends on which financial or economic pressure point is causing the most immediate strain. This brings policymakers to a core dilemma, a fundamental trade-off between near-term stability and long-term credibility. On one hand, a central bank may choose to prioritize market functioning. If Treasury markets become disorderly, or if funding stress begins to cascade through the financial system, deploying liquidity tools can feel like a necessary step to prevent a wider crisis. This could involve slowing the pace of balance sheet runoff or even restarting asset purchases to ensure markets can clear. The immediate effect is to restore order and lubricate the system. However, this path is not without its own risks. Injecting liquidity, even for technical reasons, can be interpreted by the market as a broader shift in policy. It can reshape inflation expectations, signaling that the central bank's tolerance for inflation may be higher than its stated targets suggest. It can also impact currency confidence, as perceptions of a more accommodative stance can weigh on a currency's value. In this A-B structure, prioritizing stability may risk undermining the very inflation and currency anchors the central bank has worked to secure. On the other hand, a central bank could choose to remain restrictive, prioritizing its inflation-fighting mandate above all else. This would mean continuing with rate hikes or maintaining a high policy rate and proceeding with quantitative tightening, even in the face of market strain. The objective here is to break the back of inflation and re-anchor expectations firmly. By demonstrating an unwavering commitment to its price stability goal, the central bank reinforces its credibility. Yet this path also carries significant risk. Tighter financial conditions, if sustained or intensified, can expose vulnerabilities in the financial system. The risk of a disorderly market event, a credit crisis, or a sharp economic downturn increases. A commitment to restrictive policy could push the financial system toward its breaking point, forcing a more drastic, reactive intervention later. In this scenario, staying restrictive to fight inflation risks, triggering the very financial instability that liquidity tools are designed to prevent. The policy choice, therefore, becomes a difficult navigation between these two undesirable outcomes. The context for this trade-off is complicated further by the sheer scale of sovereign debt. When government debt levels are exceptionally high, the feasibility of maintaining extremely tight monetary policy over a prolonged period comes into question. High interest rates increase the government's cost of borrowing, and a larger debt stock means that even small changes in interest rates have a significant impact on the fiscal balance. Over time, the mounting cost of debt service can itself become a source of instability, creating a feedback loop where higher rates lead to a worsening fiscal outlook, which in turn may require even higher rates to attract buyers for government debt. This dynamic can create a practical limit on how high and for how long a central bank can keep policy rates elevated. The weight of the debt acts as a gravitational force, constantly pulling on the ability of the central bank to maintain a restrictive stance indefinitely. This doesn't mean a central bank is forced to act, but it does suggest that the constraints on its policy options tighten considerably as the duration of a tightening cycle extends. Given these complex interactions and trade-offs, the outcome is best framed not as a single certainty, but as a range of potential scenarios. The path forward is not predetermined. In one scenario, policymakers successfully navigate the trade-offs, tightening policy just enough to cool inflation without causing a major financial disruption, before gradually normalizing. In another, market stress could compel a faster-than-expected return to more accommodative policies, potentially allowing inflationary pressures to become more embedded. In a different scenario, a commitment to fighting inflation at all costs could lead to a significant economic contraction and a severe repricing of risk assets. It is within this spectrum of possibilities that different asset classes may perform differently. In scenarios where currency confidence erodes or where central banks prioritize stability through liquidity, real assets, perceived as scarce and durable, such as precious metals, have historically performed well as they are less tied to the promises of a specific policy regime. As conditions evolve, the flow of capital is likely to adapt. Should market stress lead to a return of broad liquidity injections, it could reignite rotation into themes of scarcity and real assets, which often thrive when nominal assets are being debased. The same liquidity that calms markets can also seek out assets with intrinsic value that are insulated from inflationary pressures. Conversely, in scenarios where financial conditions remain tight or tighten further, risk assets like equities could face continued drawdowns. Higher discount rates, slowing economic growth, and pressure on corporate earnings create a challenging environment for stocks. The system bends through its constraints, and as those constraints tighten, capital tends to rotate toward what feels most scarce and durable. This repricing is not a one-time event, but a continuous process of discovery as markets digest the evolving policy landscape. The key question for the next phase is how this repricing might unfold, which depends heavily on the assumptions one makes about the path policymakers will ultimately choose. As we move forward, the challenge will be to understand what these repricing scenarios could look like under a new set of assumptions. What happens when the market begins to price in a different policy function, one where the reaction to financial stress is just as important as the reaction to inflation? This brings us to Section 4, where we will explore the potential repricing across asset classes if the market has fundamental assumptions about the policy framework begin to shift. A repricing event doesn't require a perfect storm, just a convergence of sufficient pressure points. Our framework uses market structure and momentum to analyze these scenarios, shifting the focus from headlines to underlying mechanics. This section is about conditions and assumptions, not guarantees. We explore a set of scenarios anchored in one primary assumption: a sustained period of long-term strength for gold. From this foundation, we can build a conditional case for silver's upside potential. The emphasis here remains on conditional. Silver's path is not independent. It is deeply intertwined with gold's trajectory and the broader macroeconomic environment. If our core assumption about gold proves incorrect, the scenarios for silver that follow become far less probable. A gold-silver ratio is a critical mechanical link in this framework. Historically, the ratio has fluctuated, but it has often reverted toward its long-term averages during periods of precious metals strength. Currently, the ratio remains elevated, indicating that silver is relatively undervalued compared to gold. The logic is straightforward. If gold begins a sustained rise, and if the gold-silver ratio simultaneously starts to compress toward its historical norm, say, from the 80s down toward the 60s or 50s, then a higher silver price becomes a mechanically plausible outcome. This isn't magic. It's arithmetic. For example, if gold were to reach a hypothetical level of $3,000 per ounce, a ratio of 60-to-1 would imply a silver price of $50. If that same ratio compressed to 40-to-1, the implied silver price would be $75. These are not predictions, but illustrations of the leverage inherent in the ratio. The entire premise, however, rests on those two crucial ifs: if gold rises and if the ratio normalizes. Mining equities offer a way to gain leveraged exposure to this potential repricing. When metal prices rise, the fixed cost nature of mining operations means that profit margins can expand disproportionately. A 10% increase in the silver price might lead to a 30%, 50%, or even greater increase in a miner's cash flow, assuming costs remain stable. This operational leverage is what attracts many investors to the sector. However, this leverage comes with significant, non-negotiable risks. Mining is a capital-intensive business fraught with operational challenges. Mines can face geological disappointments, equipment failures, labor disputes, and regulatory hurdles. Rising energy and labor costs can compress margins, even if the silver price is increasing. Furthermore, financing risk is ever present. Many junior and mid-tier miners are not consistently profitable and rely on capital markets to fund exploration and development. This can lead to shareholder dilution as companies issue new stock to raise cash. Therefore, while miners can amplify gains, they also add a distinct layer of volatility and company-specific risk that is entirely separate from the price of the underlying metal. An investment in a mining company is as much a bet on its management team and operational execution as it is on the silver price. History provides a useful, albeit imperfect, guide. Silver has demonstrated an ability to move with surprising speed when certain macroeconomic conditions align. The late 1970s and the period between 2009 and 2011 are two prominent examples. During these times, a confluence of factors, including high inflation, currency debasement concerns, and a flight to real assets, created a powerful tailwind. These historical spikes show that when sentiment shifts decisively, silver can reprice much faster than linear projections would suggest. It does not move in a slow, orderly fashion. Instead, its price action is often characterized by long periods of range-bound trading, punctuated by sharp, rapid advances. This behavior is a function of its dual nature as both a monetary and an industrial metal, combined with a relatively small, opaque market that can be overwhelmed by sudden shifts in capital flows. A sharp and sustained repricing in the future would likely require a similar alignment of multiple forces. It would not be driven by a single catalyst. First, it would necessitate a significant repositioning by institutional investors and a broader rotation of capital into hard assets. This would likely be triggered by a loss of confidence in traditional financial assets like bonds and equities, perhaps due to persistent inflation or a sovereign debt crisis. Second, this investor-led demand would need to coincide with industrial urgency. If corporations, particularly in the solar and electronic sectors, perceive a looming supply crunch, they may shift from just-in-time inventory management to strategic stockpiling. This industrial hoarding would add a powerful, inelastic source of demand. Finally, the combination of these two forces would attract momentum-driven speculative capital, amplifying the upward price pressure. It is the convergence of these three distinct sources of demand long-term investment, industrial necessity, and short-term speculation that could create the conditions for a significant repricing event. Without all three acting in concert, any rally is more likely to be temporary and fade quickly. The scenarios discussed here, from a mechanically derived $50 target to a more aggressive repricing, are entirely contingent on a specific set of assumptions holding true. They depend on sustained gold strength, ratio compression, a favorable macro environment, and the simultaneous alignment of multiple demand drivers. These are significant hurdles, and there is no guarantee they will be cleared. The purpose of this analysis is not to forecast a specific outcome, but to understand the conditions under which such an outcome becomes plausible. It's about building a framework for interpreting market signals as they emerge. As we conclude this analysis of repricing scenarios, the key takeaway should be the importance of a resilient and strategic approach. The future is uncertain, and markets are complex. Instead of betting on a single outcome, a sound strategy involves preparing for a range of possibilities. This brings us to our final section, where we will synthesize these ideas and focus on building a robust portfolio designed to weather volatility and capitalize on opportunities, no matter which scenario unfolds. This is not about prediction. It is about preparation. The point isn't certainty, it's resilience. When bond stress rises, the definition of safe can change faster than many expect. The true goal is to build resilience through awareness, not to chase after fleeting predictions. And when confidence shifts, prices can reprice quickly, quietly, and all at once. For a long time, the financial system operated on a set of comfortable narratives. Many relied on the assumption that low inflation, stable growth, and predictable central bank support would continue indefinitely. These conditions created a sense of security, allowing investors and institutions to anchor their strategies in what felt like a permanent reality. However, relying on these narratives can become a vulnerability when the underlying conditions begin to tighten. When the environment shifts, those who have not prepared for alternative scenarios may find themselves reacting to events rather than anticipating them. The transition from a stable, low volatility world to one of heightened uncertainty is often subtle at first, making it easy to dismiss the initial warning signs until the pressure becomes undeniable. The focus, therefore, must shift from prediction to preparation. True resilience in this environment is not about correctly guessing the next inflation print or the precise timing of a policy change. Instead, it is about understanding the intricate interplay of forces that shape the financial landscape. This means closely examining the trajectory of monetary and fiscal policy, which sets the foundational rules for the market. It involves analyzing how persistent inflation erodes purchasing power over time, affecting both consumers and asset values. It requires a deep understanding of funding conditions, as the availability and cost of liquidity can dramatically alter market behavior and stability. By concentrating on these fundamental drivers, we move away from a reactive posture and toward a proactive one, building a framework that is designed to withstand a range of potential outcomes rather than one that is optimized for a single specific forecast. This entire discussion is framed as an educational exercise. The objective is not to provide definitive answers or to declare one specific path as the truth. Rather, the goal is to foster a deeper awareness of the scenarios that could unfold. It is about understanding the trade-offs inherent in every decision and recognizing how different economic conditions can impact various asset classes and strategies. By exploring these possibilities in a neutral, analytical manner, we can better prepare for a future that is, by its very nature, uncertain. We encourage you to follow our ongoing analysis as we continue to monitor these developments, providing insights to help navigate the evolving economic and financial environment. This is a continuous process of learning and adaptation, where the primary aim is to enhance understanding and promote strategic thinking. The core of this analysis is that confidence is not a constant. It is a variable that can shift with surprising speed. The market can absorb stress for extended periods, moving with a deceptive quietness that masks the building pressures beneath the surface. Narratives that once seemed unbreakable can fracture, and assumptions that were widely held can be abandoned in a short span of time. When that critical threshold is crossed, the repricing of risk is rarely a gradual or orderly process. The quiet accumulation of stress gives way to a sudden, system-wide adjustment. It happens quietly, then all at once.